Good afternoon. This is Russ Murfitt, U.S. Investors International Financial Advisor. Welcome to my clients and friends of clients who may be watching this presentation. This is a workshop that is the third of three that we've done on tax planning for the 2021 tax season for your 2020 taxes. I think this is probably the most relevant one for most people because there's something in this that will affect virtually everyone, either now or in the future. So there's an attachment to this email that's got a lot of information that I think you'll find useful going forward. So you're probably going to want to keep track of that. And if this raises any questions for you, please don't hesitate to give me a call, because there are a lot of things that are going to be new. So let's get started with our workshop. And first thing is that it's always important to focus on 5 areas of financial planning that we work with: preservation planning, retirement planning, tax planning, estate planning, and of course investment planning. Today's presentation is about the Secure Act, which affects retirement, tax, and estate planning. However, as a comprehensive wealth management firm, we try to always consider the impact of any recommendation we make on not just one, but all of these areas for our clients. Today's topic, the Secure Act, is an acronym for Setting Every Community Up for Retirement Enhancement Act for 2019. It contains numerous provisions intended to make it easier for businesses to offer retirement plans and individuals to save for retirement. It also made significant changes impacting existing retirement plans. One of the major changes enacted by the Secure Act was to change the age that requires a retirement account owner to take a required minimum distribution. The RMD rule now has moved from starting to take distributions at 70.5 to 72. The old law required distributions started in the year you turned 70.5, so it depended on what month your birthday was in. The new law changed this to begin by April 1st in the year after you reach 72. So if there's a year that you turn 72, you have to start taking distributions the following April. Another major change enacted was to remove the age limit that did not allow those who earned income to make a traditional IRA contribution after 70.5. Now you can make up to a $7,000 contribution, which is a $6,000 regular contribution plus $1,000 extra for being over 50, which you obviously are if you're over 70.5. However, if you do make this contribution over 70.5, it reduces how much you can use from your retirement funds in a qualified charitable distribution. If you're considering this new opportunity, please coordinate with us and your tax preparer for details. While this is not part of the Secure Act, the qualified charitable distributions are a strategy for many retirement savers. This provision allows retirement savers to directly distribute up to $100,000 to eligible charities straight from your retirement account after age 70.5 and not pay tax on this distribution. So the new RMD age is 72, but this still is allowed to make this contribution at 70.5. One idea that experts suggest is if you're charitably inclined, consider using part or all of your required minimum distribution, RMD, for a qualified charitable distribution, QCD. Like many of the other strategies we're discussing today, this is one you should see us about if you're interested, and we'll evaluate your situation and help you out with it. Another major change enacted by the Secure Act was to create some 529 plan rules. They include the ability to use up to $10,000 over your lifetime for qualified student loan repayments. Another major change was to remove the 10% retirement account penalty for up to $5,000 of funds if you were under the age of 59.5. This is only for expenses incurred within a year of this childbirth or adoption. There are abilities to repay this into the plan, so if this is a strategy that you would consider, see us or your tax advisor for more details. The Secure Act made sweeping changes to how inheritors need to take funds from a retirement account after the death of the owner. This is a significant part of it. The new Secure Act created a 10-year rule that basically requires all inherited IRAs, Roth IRAs, and qualified plans, which could be a 401k, other things like that, have to be distributed within 10 years of death. It does make exemptions for certain types of beneficiaries. They are, of course, surviving spouses. There's no requirement to take it out. Employees' children under the age of majority, not grandchildren, just children. If you're disabled, chronically ill, and additionally non-spouse beneficiaries who are less than 10 years younger than the IRA owner. For example, if you had a sibling that was just 7 years younger. So the old rule, IRA owners could leave their IRA to heirs who could stretch their withdrawals over their lifespan. The new rule, the 10-year rule, says that no requirement for annual distributions. The account just has to be fully distributed by the end of the 10th year, following the year the account owner dies. So it's not a certain amount each year, you just have to have it all taken out by the end of the 10th year. Your objective is to still reduce your taxes and take advantage of tax deferral as long as possible. For some beneficiaries, the 5-year rule may apply, so talk with a tax advisor to evaluate your situation. Also remember that if some plan documents of a company retirement plan can override the 10-year rule. This changes many of the planning strategies that experts have recommended. According to industry experts like Bob Keebler, one of the old rule's best practices was, whenever possible, leave all of your retirement assets to your spouse, who upon their death would leave them to an inherited IRA to your children or heirs, who then have the option to stretch the withdrawals over their lifetime. This enabled a potentially very long period of tax deferral and hopefully asset growth. If you now leave your retirement funds to your spouse, they still must take distributions over their lifetime. And as this example shows, if your spouse dies 8 years later, then that person leaves it to beneficiaries who are subject to the new 10-year rule. Again, industry experts like Bob Keebler are now sharing that the potential new best practice is to review a plan that would consider, if appropriate, leaving some of your retirement assets to your spouse, who, upon their death, would leave those assets to an inherited IRA to heirs, and also leaving some directly in an inherited IRA to your children or others. You could potentially create a spread of tax liability over more brackets and more years. Back to the example, when your spouse dies 8 years after you do, as an example, during those 8 years, your spouse and beneficiaries, who have a 10-year rule to take out their inheritance, could be taking distributions, and then, after your spouse dies, their beneficiaries are subject to the new 10-year rule on the final amounts left. This strategy could potentially, if it makes sense tax-wise, spread the tax burden over 18 years, not 10. And depending on what their tax rate is, that might make a significant difference in their taxes. And the 10-year rule reminds us that a proactive approach could potentially reap rewards. To maximize your situation under the 10-year rule, you may want to consider Roth conversions and possibly spreading distributions over many years and lower brackets. Unlike distributions from regular IRAs, Roth IRA qualified distributions are not taxed. A critical area to review because of the Secure Act is what we refer to as family tax bracket management. Logically speaking, if you're in a higher tax bracket than your beneficiaries, then it might make sense to let them take distributions in their tax bracket rather than in yours. However, if your beneficiaries are in a higher tax bracket, then it might make sense to take distributions in your bracket, convert those accounts to Roth IRAs, and leave them an account that still has to be taken out in 10 years, but it can grow tax-free. The first step is to review your marginal tax rate and your beneficiary's marginal tax rate each year. Let's review tax rates for a minute. Here are the current tax rates for married filing jointly and single filers. Something that you need to remember is that even if no changes are made to tax rates, in 2026, the law says we go back to the older, higher rates when making your plan. We need to remember that. Let me say that again. The tax law calls for a sunset in 2026. So the laws say we go back to the older, higher rates automatically in 2026. As this arrow shows, for some people, that means a large withdrawal could mean what is today taxed at 24% could be taxed in 2026 at 33%, a much higher rate. How can you make the mathematics of IRA conversions work for you? Your personal critical decision factors include tax rate, your use of outside funds to pay the income tax liability, the need for IRA funds to meet annual living expenses, Rmd considerations. Remember, those begin at age 72. If you convert to a Roth IRA, Roth IRAs do not have RMDs. Time horizon, how old are you and how long can you defer taxes, estate tax considerations, and the 10-year rule. Not easy choices, and we can help you review your situation to make a good decision. Many experts, again like Bob Keebler, are suggesting that a sweet spot for considering using partial Roth conversions could be for those who can currently fill up as high as the full 24% tax bracket, and after the sunset goes as high as the 28% bracket. Again, don't worry too much about trying to figure this all out. Be more than happy to go through the numbers and help you with it. Some other reasons to consider Roth conversions, if appropriate, could include tax brackets could rise in future years, and your account might be down from a drop in the market. When we have market volatility, that sometimes presents a good opportunity to move funds into a Roth IRA while they're currently at a lower value. They could lower. Some benefits from Roth IRA conversions include lowering the overall taxable income long term. Roth IRAs enjoy tax-free compounding. They have no RMDs at age 72. And Roth IRAs allow tax-free withdrawals for beneficiaries. If they're in a much higher tax bracket than you are, that could be a major advantage for them. As part of our family tax bracket management strategy, we also want to confirm your beneficiaries and contingent beneficiaries. So there's a method to the madness, so to say, when we're asking for some of that information. To maximize your options for transferring wealth, we should check your primary beneficiaries and your contingent beneficiaries. Whatever strategy we end up evaluating, we can help coordinate your opportunities with your tax preparer. So, some key takeaways. The Secure Act has permanently changed retirement. Your situation and the 10-year rule should be reviewed. Let's take a look at it. Our goal is to help you understand your choices. Your health is our highest priority, and continue to focus on your personal goals and call us with any questions. So what do you expect from us? We know you know this, but regular communication, frequent visits, discussions, and we're continuously reviewing economic, tax, estate, and investment issues for our clients. Thank you for your time today. Remember, your health is our highest priority. We appreciate the opportunity to assist you. We enjoy having you as clients. We look forward to helping you and others in 2021. And please feel free to share any of this information. If you would like to do that, you can call our office at the number on the screen right here, and you can send an email to Dion Llewellyn at this email address, and we would be more than happy to add somebody to our list and send them out the same information. So thanks again for listening. Look forward to seeing you soon. Take care.